Okay, so good morning, everyone, and thank you for joining us for another Pulse webinar. I'm Steve, the head of marketing here at Navia Global, and I'm delighted to welcome another Stephen who's joined us this morning. Stephen Yu is the CEO of the Blue Whale Growth Fund. Thank you for joining us, Stephen. I perhaps you said that I'm delighted to welcome you back, actually, Stephen, because you've been with us twice before. I know you've recently celebrated your 8th anniversary, but you actually joined us in February 2023 for the first webinar, and you spoke about how Nvidia was going to be the next trillion-dollar company. I think I had a quick look at the stats, and that took about 3 months after the webinar to come to fruition. And now, three years later, they're over 4 trillion. So things obviously have changed a lot over the 2.5, 3 years. And I'm sure the Blue Whale portfolio has as well. So it'll be really interesting to hear how that's changed. I mentioned Nvidia's growth, and I'm not an expert, but I'll probably class that as explosive growth. And in today's webinar, we'll be focusing on 3 types of growth: a steady, recovery, and explosive. What these mean, some examples of them, and how the Blue Whale team identify the outperformers in those categories. So before I pass over to Stephen, just a couple of quick housekeeping things. A recording of the webinar is going to be sent out to everyone after, along with a copy of the slides. And during the webinar, if you ask any questions in the little Q&A box, we'll make sure that we can try and cover as many as we can at the end. So with all that said, I'll pass over to you, Stephen. Many thanks.
Thank you, Steve, for the introduction. Thank you very much for joining us this morning. Before I kick off with what I've prepared today, which is to talk about the different investment opportunities across different growth spectrum, I would say, I just want to give a very quick recap of what we are trying to achieve here and how are we going about picking some of these companies in terms of the investment process. So the way that we run the strategy, which we have been doing this for the last 8 years, since September 17, is we run a very high conviction mandate with between 25 to 35 stocks. So on average, you can think about we run a 25 stocks portfolio, which I would say is pretty concentrated, just because when you look at for example, like the iShares MSCI World Index, which most people would have as a passive stock market tracker, there are about 1,500 stocks in the market. So when we are trying to pick only 25 of them, then it's a pretty concentrated portfolio. And of course, the way that we go about this is to do it in a high conviction manner. So within the investment team, there are 5 of us, and we do all the work in-house. We don't speak to sell-side analysts. We don't read brokers' research, and then we just go through all the primary sources of information to try to get a view on our companies. And the way for you to think about this is when you have 5 investment professionals, on average, probably covering 5 companies each, so 25 divided by 5, then the amount of time and effort and details that we will go into per company would be a lot more significant than maybe some other peers who might have fewer people covering the same number of companies, or maybe they have similar headcounts, but then covering many more companies. So this is, I would say, much more of a maybe kind of like an investment resource exercise, or very much of a marginal gain, or basically deep dive into things that some of our peers might not be able to do so to get some inside track. So that's what we do. And on the back of that, we also build unique financial model for every company we have in the fund. And we make forecasts, we look at valuation, we look at free cash flow yield, adjusted for debt, which I will come back onto when we look at some of the magnificent 7 companies that we don't own, most of them with the exception of Nvidia. And the reason why we are a bit cautious about some of these, I will come back onto later. So that's how we go about investing. So then I think the one thing that that's really important from our perspective is the way that we think about companies in our fund. Obviously, we would probably define ourselves as quality growth investors. We like quality businesses with high return on invested capital profile, sustainable business model, strong free cash flow conversion, strong balance sheets, run by good management team. All that I think is a given that we like company that are of very high quality. But I think the misconception in the market typically, which has been a period of time that these companies end up doing quite well, is quality businesses would outperform the market no matter what happened in the macro environments or market conditions. And I think that is completely not true in a way that, from our perspective, every company operates in the real world. What it means is even though you can invest into high quality businesses, but it doesn't make them an outperformer, right? We want, for fund manager who are on active space, we want to have more outperformers than underperformers. That's how you deliver outperformance, or how you deliver alpha, or how we ended up justifying the active fees that we're charging relative to the passive tracker. So I think it's very important just to keep in mind that when we talk about companies or stocks, or why we decided to have certain names in the fund and no longer have other names in the fund, it's not just about this company is going to be around forever, whether this company is going to survive the different uncertainty. It's about whether this company could actually outperform significantly versus things that maybe we owned or we don't own in the current portfolio. And the other thing, just to introduce this concept first before we talk about companies, is in order to outperform, you need to have a differentiated view or perspective on the outlook of your company. And differentiated view just means that you need to be a contrarian. So you could think this company is going to make a lot more money than what's been expected. That's being contrarian too. Or you think the company is going to make less money than what has been expected. That's also being contrarian. But of course, being contrarian doesn't make you right. So at the same time, hopefully your research, your understanding of the business or direction of travel would give you a more probability of success that you are actually going to be more right than wrong. So ultimately, to understand why active managers could deliver strong outperformance over extended period of time versus some other manager who might not be able to do that, it's just a matter of how much of a view that you have on your company are different to what has been expected. At the same time, you need to be more right than wrong. So just remember that when we go into companies. So if I kindly ask Steve just to bring up slide 6,
Yep,
I would
no
just refer to this and you should be able to have access to the full presentation after this call. But I would just use this slide as a proxy, as a way in to talk about different things that's going on. It's quite a busy slide, but I will take you through one by one. So basically, the way that I try to structure this slide is the heading is quality growth, which is the approach, but we're trying to pick outperformers within the quality growth investment approach. And obviously, that would equally be underperformers, so not outperformers, that we try to avoid at the same time. So if you think about a fund that can have more outperformers than underperformers, then it's more likely that this fund will outperform the peer group or maybe the passive ETF tracker. So it's as simple as that. Obviously, picking the right stocks is probably the hardest bit with behind the scene. So the way that I have structured this, which I also have got an article within the presentation that I would encourage you to read if you're interested after this call, is basically within the quality growth spectrum, there are 3 different level of growth, and they are all very different. The playbook will be very different. How you can generate outperformance on the back of these categories would be quite different as well. So I think you need to understand what sort of growth these companies are in the current phase, and then it's a way for you to then see whether you can realize those kind of value from these companies. So if I start from the middle part, which is probably the easiest part to illustrate, is what I call the steady growth. Steady growth typically just means that the company or the sectors are growing much faster than the world GDP. So if you think about the world GDP in nominal terms, it's growing at around 5% a year. Any companies that can grow their top line, I'm talking about the revenue, more than 5%, let's say maybe in high single digit, low double digit, they would be considered as steady growth. And then they can do it quite consistently. And the example that I would use, which everyone would be familiar with, would be the digital payments company like Visa or Mastercard. And these companies, they have consistently been growing at probably low double digit for the last many, many years, and with very high margin profile, very strong management team, very strong balance sheet. I'm sure everyone would be very familiar with this company. But of course, the difficulty with these companies are that is everyone understood the quality aspect of this company, and hence when you look at the multiple or the valuation that you're paying for this company are typically quite high rather than on the low end. You probably never would almost never see like Visa and Mastercard trading at, I don't know, 15 times PE ratio, right? It's probably more in the range of 25 to 30 times PE ratio, just because everyone are very happy to pay a premium for companies that can have a sustainable earnings. At the same time, the growth has been quite sticky in a way that they can continue to deliver quite a high level of growth, irrespective of what's going on in the world. So then the way to realize outperformance from some of these steady growth companies is you need to invest and hold on to the shares when the valuation is a lot more attractive. So what I'm trying to say here is if you ended up, for example, holding on to maybe Visa, MasterCard over the last 10 years, I think you would have done pretty well relative to most other companies in the market, or even maybe versus the market in itself, the iShare MSCI World Index, the ETF tracker. But of course, if you really then follow the kind of the share price trajectory over the last 10 years, is that would be times that these shares would be, I would say, overvalued, and there will be times that the shares are trading at a discount to the value that they're offering. So I think the playbook, if you want to maximize outperformance, which is what we're trying to do here, it's not just realizing outperformance, but you want to maximize the outperformance or the level, the rate that you're compounding at, or the rate that you're outperforming at. Then you need to assess the valuation to see whether the valuation is very attractive so that they can actually have the potential to deliver a lot more outperformance than probably very little outperformance. I will come back onto some of the names I listed out on that, like Philip Morris, Uber, and Lam Research later. The other one, which is recovery growth at the bottom, is it typically means company that are of very high quality, I would say, that have no structural issues, but they are going through a phase of cyclical challenges. So if you think about luxury brands, they are in that position just because the Chinese high-end consumers are spending a lot less money now, or maybe the economy not doing well, and hence they're spending less money in luxury goods. At the same time, the inflation narrative in the Western domain for some of the aspirational spenders, they're probably being rein in, as in like they have less money to probably buy some of these products. So basically, when you look at um, the the sector, the luxury sector as a whole, that is not been growing, or it has been probably shrinking a little bit over the last few years. And but to us, we do not have any structural concern that the luxury sector is broken. We think it's going to come back at some point. I mean, you can argue that any countries with money, maybe Middle East, at the moment, I mean, they do spend quite a bit of money buying luxury brands. And at the same time, maybe at some point you would have India coming up to be the new China, and people with a bit of wealth would probably want to have a bit of exposure to upgrade kind of their look and feel as well. So that is our view. But of course, where you are today is the sectors are not doing well. So the way to do it, which is what we have Montclair in the fund, we also have Burberry in the fund as well, is you want to invest into companies that when the valuation is very attractive, I think both of them are, But at the same time, you do want to have some idiosyncratic drivers so that they could still be doing well while the sector in itself is not doing as well as before. So Moncler, the idiosyncratic drivers would be a combination of them being a smaller brand. They can open more distribution, more stores in big cities. At the same time, they're trying to de-seasonalize their offering away from the winter jackets that we're familiar with. Then Burberry, if you follow the story, has done very well actually this year. Is a turnaround story. They got a new management team in place. At the same time, they have probably going back to the roots of being more British than fashion-led house, which they were part of this fashion-led kind of journey over the last few years, and I think that has not worked out too well for them. So what they're doing now is going back to the roots of being more British, and you already can see some success coming out from customers going back to the brand over the last couple of quarters. So that's recovery growth. But what you need to do though within the recovery growth, the playbook is the timing is very important because it's very difficult to get the timing when is the right time to get involved and to make a lot of outperformance because the opposite of that spectrum is the waiting time could be quite long too. You could be investing into these companies and then you end up waiting for a couple of years before they recover. Then to us is more of an opportunity cost, which is also very important, even though that maybe this company is just going sideways in terms of share price, which is what had happened. But you could have invested into many other stocks that would have gone up and have delivered outperformance. So then it's more about sizing the exposure accordingly. So to us, luxury brands is not a big part of the portfolio. I would say probably a couple of percent. But when the time is right, we can easily size up our exposure quite quickly. And also we could introduce some other names into the fund quite quickly as well. So that is something just to bear in mind that this is recovery growth is very important to get the timing right. But of course, you can't read. No one has a crystal ball, and then what you can do is to size the position accordingly, so that at least you are following the company very closely, but without the potential of detracting too much outperformance from the portfolio. The last category I would probably spend a bit more time to expand on, and very happy to take question later on if I haven't got time to run through all the stocks on this slide, is explosive growth. This is an area or category I think is quite unique to us because if you follow other quality growth manager, they probably would have a similar categories like steady growth or recovery growth. Maybe the companies will be different, but I think the high level understanding will be very similar. But explosive growth, I would say that is pretty unique to us. I think most managers wouldn't have this exposure, and also the term in itself could be a bit misunderstood because people are saying, oh, explosive growth probably means maybe your Cathy Wood's ARC strategy or maybe the Baillie Gifford Scottish Mortgage. So it's a lot of unprofitable companies spending a lot of cash to win market share, and then they're growing very quickly, but then there's no quality of the company to back it up. So that is not that we are interested in. So I already mentioned, if you see the heading, all of these companies are highly profitable. They're all quality businesses or high quality businesses. They have very strong or robust business model, free cash flow conversion, strong balance sheet, and all that. So these are explosive growth opportunities within the quality spectrum. So just bear that in mind. These are not unprofitable businesses that are trying to grow quite significantly, irrespective of how much cash they're burning. The two examples I would share before I go into AI is the first one will be quite unique to us as well. I would say is European defense. So European defense, as everyone will understood it by now, what had happened since Trump came on board. But from our perspective, we only started going into European defense probably in early 2023. So on the back of the Ukraine invasion in 2022, there was already a wave of kind of performance in European defense at the time. But of course, the way that we look at it is not so much about Ukraine, it's where the world is heading. So you need to take a forward-looking view, which I will come back onto. It's a very important point that you cannot take a backward-looking view, which sounds uh, reasonable, but that's not what most people are doing. Most people would actually take a backward-looking view when they look at historical metrics, when they do quantitative screening. We do not do quantitative screening. Everything is historical, right? You need to take a forward-looking view. Then what happened was back in 2023 that we can see the world is going to be a lot more, I would say, unsafe, or there's going to be more spending that we need to invest into as far as Europe is concerned. But of course, I think what has been the inflection point is when Trump was elected back in late last year, and I start running the office early this year. And of course, when you think about European defense, it's basically a net beneficiary on the back of Trump's policy. There are not many sectors that are actually benefiting from Trump's policy, but European defense would be one of the few that are actually benefiting directly for Trump basically saying to Europe that we don't care about Russia. We're not going to cover your back. You should sort yourself out. That's what Trump said to Zelensky quite early on in this year. So then when you look at the share price at NATO has almost doubled this year, which has gone up almost 100% this year. So we have done very well on the back of this. But I think the important point to think about is it's all about forward-looking view rather than backward-looking, which I will come back onto later. The other one that you might be familiar with would be US sports gaming. Flutter used to be listed in the UK. Later on, we headquartered in the US. So now it's a US company. But sports gaming in the US has never existed until about 5 years ago. Of course, in Europe, in Asia, sports gaming has been around for years. But in the US, sports gaming has never existed until about 5 years ago that they started to legalize sports gaming. So what have happened since then is by now in 2025, 50% by states in the US or 50% by population would have access to sports gaming. What do we know about sports market in the US? Firstly, we know that the US sports market is the biggest in the world. So they love their sports. American love their sports. Secondly, we know that American, as a generation cohort, a few hundred million population, is probably the wealthiest cohort in the world, right? So they love their sports, that they have money to spend. What do you think is going to happen when sports gaming is going to be legalized? Of course, it's going to explode. So then what happened this year, in 2025, when you look at the gross gaming revenue in the US sports gaming market, has gone up to about $100 billion, which I would say is a very big number. And only about 5 years ago, that number was zero. So, so basically, the gross gambling revenue in sports was zero 5 years ago, and now it's $100 billion. And the legalization journey continues. Okay, where the quality of the business come in the US is more of a duopoly. So it between Flutter sub-brand called FanDuel alongside another listed company called DraftKings. These two companies control about 80% of the market share. So that is very high quality, I would say, or very strong market leading position. The last one I would just quickly mention that I'm sure people would probably want to ask me questions on this is AI, artificial intelligence, but I would just give a few numbers. So the first number I would give is if you have done any work in Nvidia back in 2022, Nvidia revenue in 2022 was at around $30 billion. Okay, still a big number, $30 billion after Nvidia have been around for 20 years, run by the same guy, Jensen Huang, and very strong product offering GPUs, but obviously GPUs selling to the gamers, selling to the crypto miners, a bit of real-time recommendation systems for YouTube, Netflix at the time, 2022. And you probably would have missed Nvidia, right? Like, or you have done work in 2023, which I think Steve mentioned that we had a call at a time that we tipped Nvidia to be the next trillion-dollar company. And even by the time you see Nvidia have surpassed $1 trillion in market cap terms in June 2023, you could still have missed it because the revenue at the time probably would be about maybe 40 billion. Not, it's not gone up a lot. But of course, when you look at Nvidia today, which is only 3 years later, the revenue that Nvidia is making this year has gone up from $30 billion in 2022 to about $200 billion today. So the way to have a differential angle is to is to take a forward-looking view, is to understand how the GPT technology or generative AI technology is going to take us, which is where we are now part of. Today, I think a lot more people today will be using some sort of GPT tools in their day-to-day, whether it's Office Copilots or ChatGPT, Gemini, and some others. And then secondly, you need to understand where the monies are coming from. So the money, the revenue that Nvidia is making today is all coming from the free cash flow that generated by the big tech companies. And we are equally taking a forward-looking view that we are very cautious on AI spenders, but we are more positive on companies that are on the receiving end of any AI spending, which is what we have in the fund. So currently, we don't own any of the Max 7, with the exception of Nvidia. But I will just stop here for a second. In terms of the AI, I'm very happy to resume this because this is a much bigger conversation, and we're seeing some very interesting development in terms of how we're seeing the next leg of opportunities within AI. But when you put all this together, so just to summarize, is you need to take a forward-looking view. Your view need to be different. So hopefully you have done enough research, you have built financial model, you have made forecasts that you expect your company to make more money than is being expected. And then you need to be more right than wrong. And then if you can do that quite consistently, which we have done over the last 8 years, then you ended up delivering a lot of outperformance for investors. And then if you haven't done too well, many of the things I just outlined, then you probably ended up underperforming, which is, I would say, probably majority of active funds are a bit behind the curve, and they ended up not beating the equivalent iShare MSCI World Index ETF, which is quite much more of a fact or unfortunate fact. I think that is why the investing is a very competitive kind of sports in a way. So I will stop here and happy to take any questions. Yeah, and I will pass the mic back to Steve.
Thank you, Stephen. Some really interesting thoughts and insight there. As expected, we do have quite a few questions come in, so let's get started. I think we just carry on the topic of Nvidia and AI, I suppose, to start with, is how much more growth is there? You mentioned how much they've grown, and 4 trillion plus. There's maybe other elements of AI that are coming into it. I noticed Palantir, they've got over 550 PE ratio. They keep going up. So give us a bit more thoughts on companies like that and where you see it going, please.
Yeah, so firstly, I would try to keep my answer short, but very happy to expand on this if we do have more time. So do come back with follow-up questions. So firstly, we have said this quite a few times already at the beginning of this year, that the rate of return or outperformance that you can expect to get from Nvidia from here is going to be a lot less than if you have invested in Nvidia back in 2023, 2024, which we did, right? We made a lot of money from Nvidia. But the way to think about, okay, so how do you then square the valuation of Nvidia versus the rate of growth versus the rate of outperformance, etc., is of course, I mean, Nvidia, if you look at the short-term PE ratio, I would say it's trading at probably low 30s. which is not totally unreasonable when you have a company growing at 50% a year. But of course, then the question to come is, which is very different to Palantir because they're not as profitable, right? I mean, the P ratio is a few hundred times, and of course, when you look at Tesla as well, it's also very high P ratio just because they're not very profitable, or not as profitable as Nvidia. Nvidia is making almost a 50%, 50% of free cash flow margin. So the $200 billion that they're making in revenue, 50% of that is going to be free cash flow, and free cash flow is after capital expenditure they can use to do share buyback, make acquisitions, pay dividends, or have the cash stay on the balance sheet. So that's what free cash flow is. So it's actually quite a significant number, I would say. The other thing about NVIDIA or the AI is we are a true believer in how AI is going to change the world. And the way for some people to think about NVIDIA is NVIDIA would remain the core of the AI conversation because it's all about GPU compute. There's only two companies in the Western domain that I would say that is the most significant part of this conversation. One is NVIDIA, the other one is Broadcom. So what Broadcom does is they do the in-house GPUs for the big tech companies. So you have seen Alphabet, Meta, and some others. They would have worked with Broadcom to have some of their AI application to be run on a customized GPU, which is produced by Broadcom, rather than using NVIDIA because it's a lot more expensive, and also they probably not want to be overly dependent on one single supplier, which is NVIDIA is a very powerful company. However, the way to think about, okay, then what was going to happen then? Okay, is NVIDIA going to not make 200 billion next year and then suddenly that number goes back to 30, right? That's the most important question. But then I think the way that I think about this is a bit more similar to your Apple ecosystem. If you think about Apple, they're making about $400 billion revenue and not growing a lot. I mean, they're growing a mid-single digit, probably a few percent a year. But the reason that Apple is still trading, I would say maybe at a very high valuation, probably 25 to 30 times earnings, is because even though that you're not upgrading your smartphone every year, you would be upgrading it every 3 to 5 years. So you're still within the ecosystem. So if you think about NVIDIA GPUs, it could be very similar to your smartphone devices that you would have a replacement cycle. Of course, how significant the number we get to, is that going to peak at $500 billion, $1 trillion? I think that is the work that we are doing day to day to track this development to see where it's going to go to. But once you get to a certain number, then you will expect a bit of a replacement cycle, which then they still need to buy NVIDIA GPU rather than you're running. It's a bit similar to your PC or laptop, right? You can't use the one that's been produced 10 years ago. I mean, it will be too slow, and it probably makes sense for you to spend some money to upgrade to the latest version. So it will be very similar to that. The last point I would point to, just for people to think about, when people think about AI. And some people are still making the case that, oh, AI is not real, AI is not going to change the world. I think what they forgotten about, what they forgot about AI is the frictional forces, the frictions for AI adoption is almost zero. The only frictional force is the availability of GPUs. It's whether you have the money to invest into GPUs, right? Which is what the big techs are doing. And if you look at a smartphone, so let's say the iOS, this is an iPhone here, there are 3 million apps on iOS. 3 millions. That is crazy, right? And you think like, why do you need 3 million apps? I mean, I probably got 100 on my phone myself because there are like 3, 4 billions of smartphone users globally. And you don't need too many people to have a successful business, right? So 3 million apps. And what are all these apps? I don't know. I have no idea. But what I do know, there's a lot of data that they have on us on the cloud, and which they can utilize AI to come up with some interesting use cases. So I think there's more things is coming that we have not seen yet, and that would require a lot more GPU compute. But of course, I mean, just to think about the rate of return that you would expect to get from Nvidia is going to be a lot less from here, but we still can expect Nvidia to outperform. But the magnitude of outperformance will be a lot smaller going forward. But it's probably but Nvidia is here to stay rather than Nvidia just disappear from the Max 7 anytime soon.
Okay, well, thank you, Stephen. I think just thinking about last time you came on, I think there was a question about Nintendo, and I think you've sold out of Nintendo now. And I saw on the news a few months ago you've bought into Uber, and I know you mentioned Uber during the presentation. It's just you have some thoughts on why Uber and where you see that going.
Yeah, so Uber is actually quite interesting. I mean, fairly new company which we added this year. I mean, the shares has done very well this year. It's gone up over 50%. Um, and I think the story about Uber, I'm sure most of our audience are familiar with, is not just a transport app. It's not just about getting a cab in cities and when you're on holidays or maybe in different places that you are in. What they are doing, which I would say is extremely promising, is they have this I mean, they got this platform now called Uber Eats, which I think they're going to change the name of this at some point. Is they're now partnering with a lot of retailers. So in the US, they will partner with some retailers. In the UK, if you're in the UK, they would partner with the Boots, the Sainsbury, the Currys, and and many others. So what it meant is, if let's say you want to do shopping, grocery shopping from a supermarket like Waitrose, Sainsbury, and some others, you would typically have to book a slot, right? I would say, okay, I booked this hour slot. You might have to book it a few days in advance, and then you'll probably have to sit at home and wait for that to happen. It's definitely not going to be same day delivery, right? If you book in the morning. But of course, what if you do ended up ordering the grocery on your Uber app? You can get it like in the next half an hour. So basically, someone just go to pick those things up. Of course, you have to pay a fee for that, but then that is the convenience. And if you think about the TAM, the market TAM opportunity set in this market is enormous. So this is a new business for them. The other one which is coming, but obviously we have to monitor how this is going to play out, is autonomous vehicles. So driverless vehicles. So there has been this narrative in the market that if people are not liking Uber as an investment, they'll be saying, "Oh, at some point we're going to have autonomous vehicle, hence you don't need drivers anymore. Hence Uber doesn't have business." But I think that's not entirely true, just because if you think about what Uber is doing, they are not actually a cab company, right? A taxi company. It's a platform to connect the service on the one side, which is basically a hailing Uber app, a cab, and then connecting with the customer who need that service. And they are actually paying out about 70% of their income to the drivers or to basically to the end suppliers. And you would have also seen that Waymo, which operate by Alphabet in autonomous vehicle, have recently partnered with Uber to do a test run in the US mostly. And so ultimately, I think if you think about Uber, ultimately, okay, if autonomous vehicle being very successful in certain cities, I mean, it's not going to be in every single city, but in certain parts of the world, I'm sure it will work better than some other more crowded cities. Then it's still a platform, right? Then they will be competing with the local drivers, but Uber is still going to pay our fee. So basically, what I'm saying here is that there's a lot more to it than some of the stuff that we might be seeing from the outside. And of course, then when you look at Uber today, not few years ago, because we wouldn't have invested in Uber a few years ago, is a highly profitable company because they already have won, I would say almost won the race to be the app that you go to for cab or for food and for other things as well. So it's actually very interesting in that perspective.
Yeah, I know. Like my kids, for example, don't know what a taxi is. I think it's always order an Uber. So it's when the word becomes the thing. Is I think we'll just have one more question, then, if that's okay. It's an interesting one. Is are there any emerging sectors or themes that you think could give rise to the next wave of explosive growth? Quantum computing's talked about, space. What are your thoughts on what we could
Yeah,
see?
I think this is always a difficult question, right? Just
Yeah.
because if we see there's certain area kind of like brewing up. We probably would have some exposure to it already, which we haven't. So it's more telling that the reason why we haven't. I think the difficulty with explosive growth or growthy opportunity, or even you think about maybe thematic opportunities, is there are many things that are happening out there that could be of interest. But if you're running an equity fund that invests into companies that are listed, so not in the private domain, and then you also have a bias, which is what we do, to define the company need to be very high quality. To tick all these boxes is actually quite hard. So, for example, like I could name a few themes, but we can't get exposure to it. It's like nuclear energy. Nuclear energy is extremely exciting, and you already can see that most of the big tech company they're building AI data center now, and then they also have acquired some nuclear plants, mostly in the US to basically to support the energy demand on those AI data center. But then if you ask me how do you actually invest in the nuclear energy, I don't actually know because many companies, the French who are probably doing the nuclear kind of energy plants, they have many other parts of their business that you're not interested in. They're quite low quality as well. And then you say, oh, you could invest in the uranium, which is an input into a nuclear plant. I mean, we don't do that for this fund. Maybe people can take a look, but obviously it doesn't. It's very different, right? When you invest into commodities rather than a company, then you need to think about other things that you're not thinking about. I don't need to think about today. The other one is EV cars. I mean, I think everyone would share that this is an explosive growth opportunity. But how do you actually make money? I think with the exception of maybe one or two companies would be mostly Chinese, that most companies are not making money. And even if you look at the Chinese player, I was just reading that there are about 150 EV car companies in China. 150. So they're killing each other as we speak. So basically competing on the price and offering more for the customers. So my point is, I don't have more explosive growth opportunity today because otherwise we're having the fun. But what is important is you need to keep an open eye. You need to keep looking. You need to be very connected. I would say connected to the real world where we are heading, right? Where we are heading. Like at the moment, I think we are heading in a direction that we need more spending in European defense. There's going to be more money invested into AI. Sports gaming is going to continue. Even like if we group maybe Philip Morris under explosive growth, we could do that too. There's more smoke-free products. We're conquering the US, and the shares has done very well. So I think that you just need to be focusing on the companies from a bottom-up perspective, and then you need to look forward. And if you keep doing it without wearing a forward-looking lens rather than backward-looking, then you would come across some of the opportunity. But whether you end up making money or outperformance from these opportunities, then it depends on whether you ended up investing into the right company. Otherwise, then you could invest into the wrong company, and then the winners that you have missed out on winners within that sector. So I think it's easier said than done. But of course, if you do spend time on it, I think you'll pick those up.
Winners. Okay, brilliant. Really interesting. We've run out of time there, but thank you for your time and joining us today, Stephen. We will be back next month with another webinar, so we'll send the invitation out to everyone shortly. I'll circulate the slides and the full slide deck, including your article, and a copy of the video to everyone that registered. So yeah, thanks again for joining us, Stephen, and thanks everyone for joining the webinar, and see you all soon. Thank you very much.
Thank you.